Hey guys, what's going on? First and foremost, apologies because the last live I was supposed to do a couple of weeks ago didn't happen because I had some issues with Wi-Fi in my area. Sky was down for like 48 hours or something like that. And therefore, we didn't get to go live. The Wi-Fi didn't actually come back on until like the Monday. So we're here now. We're going to have a little chat. I'm happy to answer any questions at all. Over the last couple of weeks, certainly on the videos, there have been quite a few questions being asked around the subject matters that I put out on. So ISIS was a big one the week before last. We continued that in the video trend this week as well. So I'm happy to take any questions that you guys have. So please make sure that you leave your questions in the chat, and I will pick them up as we go along. This will also be available for you guys to view afterwards as well. So we'll spend a little bit of time answering questions, having a chat, and we can go from there. But I hope you guys have had an amazing week. It's been a bit of a busy one for me, which is always a good thing. But as always, yeah, at the moment, I'm all about content. So one thing I do have to say as well, actually, thank you guys for, and I've said this a couple of times actually on the at the end of my videos, is you guys have been amazing with finding me on Instagram, on LinkedIn even actually. Very, very resourceful. And yeah, particularly for the podcast, that's actually now trending. Really, really nice. Well, charting, I should say, not trending, is charting really nicely on Apple, and that's down to you guys. So thank you so much for that. And yeah, thank you for the support. Thank you for the comments and everything. It's really, really appreciated. And I hope that by doing lives like this, I'm going to be able to, add value to you guys and help you on your financial journeys, because at the end of the day, that's what this is all about. It's all about me sharing my knowledge with you so that you can put your best foot forward when it comes to investing, when it comes to money management, all those good things that add value to life and help us enjoy the things and fulfill the, do the things that fulfill us. Essentially, that's what it's all about. So, hey, how you doing? Thanks for your video, sharing your knowledge. They have been super helpful. Now, thank you so much. Has there been a particular, few handful of videos that you found useful? Please do let me know, because with YouTube, obviously we've had the review videos, which have gone down really, really well. And I'm talking more and more about investing now. But I get mixed comments a lot of the time around, okay, can you do more of this, more of that? So I'm trying to kind of get a little bit of balance around the content that you guys want to see and some of the stuff that I also want to make. So what kind of videos have you found the most helpful? Has it been the investment side to the videos, the reviews, or just general money and how I position money when you invest? I'd really like to know. Hey, how you doing? Thinking about buying into a Visa/Mastercard via Hargreaves Lansdown. Do you think this is something good to hold for the long term? Okay, so Visa, Mastercard. I think whenever you're going to invest in any company, you've got to have a look at the fundamentals. Visa, Mastercard, they are pretty big companies. Let's have a look at some details though. Bear me 1 second. Let me just bring up another video here, window here, and let me just have a look at the stock price of both of those. So Visa. So $192.53 for a share in Visa right now. Are you buying this via Trading 212 free trade? Well, you're going Hargreaves Lansdown, so you're buying individual, so one whole share. So 152, yeah, pounds that is. Yeah, that's right. Let's have a look. Payments technology. Let's have a look at their revenues. 22.98 billion, net income 12, profit margin 52%, pretty good. Let's have a look at their share price over the last, let's go back over the last year or so. It's been a little bit volatile, as you would expect it to be, but actually it looks like they're back up on an upward trend. So yeah, I mean, Visa, Mastercard, some of the fundamentals that you'll be having a look at is about, what competition do they have, right? So there's Visa, there's Mastercard. They are probably the two biggest sort of payment processing people, right? There aren't that many other guys that are kind of, challenging them at the moment. You can argue services like Stripe maybe will take their place, but in terms of having something in your wallet, those two companies are the biggest in the game. So absolutely, if you want to look at holding them for the long term, then they look like they're solid in terms of businesses. They've been around for a very, very long time. Their profit margin is actually pretty healthy. I mean, 52% profit margin, that's pretty good. Dividend yield of 0.62, not bad at all. So I'd say, yeah, if you're looking to hold that, there aren't any red flags that kind of pop out at me straight off the bat right now, looking at them. Total assets 72 billion, total liabilities 37.8 billion. So debt to assets 52%. 52%, that's okay in terms of leverage, I guess. If you're looking at 70-80% leveraging in terms of debt, then you might have a few follow-up questions that you'd want to ask. But the fundamentals look good. Cash flow operating 12.78, investing 591 million, financing. Okay. Yeah, I mean, it looks good. Let's have a look at the cash flow. I'm looking at all of this on Trading 212, by the way. So on the app, if you look at Visa, you'll have the section where you can click on additional information. And I'm looking at all of this as part of the information they give you so that you can do your research. And I'm looking at cash flow. I'm looking at debt, balance sheet. Balance sheet is really, really important. Balance sheet is kind of like the snapshot of how the business is actually doing. So understanding what total assets mean. So total assets might be cash in the bank. It could be a number of things, but understanding what number they have versus their liabilities. So their liabilities are their debts. What you don't want to see is a company that has got huge debts versus their liability. With Visa in particular, you're looking at 52% debt versus liability. So they've got quite a bit of a cushion. So it's like saying you've got £10 in the bank, but you owe 5. You still got 5 to yourself, right? So that is a good position to be. It will be a really bad position if you have 10 quid in the bank, but you owe out 9 and you still need to pay for stuff, right? So the more you can have in reserves in terms of on the balance sheet, the better. So from a financial point of view, they look solid in terms of the finances. Revenues are good. Net income is really, really good. Profit margin is really, really good as well. I mean, 52.5% profit margin. You can't really go wrong with that. That's really, really good sort of stock, high level. But yeah, holding it. Obviously, you need to bear in mind as well that, stocks will go up and down all of the time. But if you're holding them for the long term, then you should be fine. All right, lots and lots of questions here. So let's try and get these through. Okay, cool. So Daniel, great read so far. What's your thoughts on cryptocurrency short-term, long-term compared against stocks and shares, ISAs? Okay, so Bitcoin cryptocurrencies, right. Be honest, that's not my area of expertise. I'm slowly learning about this kind of stuff. However, I do have I've got one contact in particular. He's very, very good with crypto. I'm picking up a lot of my knowledge with him. Now, I actually hold some crypto. I hold a little bit of Tizo, hold a little bit of Bitcoin as well. I think with Bitcoin, one thing that you cannot ignore is the performance of the currency over the last 4 or 5 years. In as much as the financial services industry in the UK does not want to acknowledge or accept the existence of cryptocurrency as a means to generate wealth, the record is there. You can't ignore it. And cryptocurrency is there to do a specific job. It's there to basically disrupt the system. It's completely outside of the control of government, central banks, and that's what it's designed to do. So therefore, it operates on its own sort of rules, if you were. I think the financial services industry that I'm part of doesn't like it because basic fundamental investment theory doesn't necessarily work with Bitcoin. And what I mean by that is if I buy Tesla is a company that makes a product. They make profit, right? Therefore, they pay dividends, so on and so forth. So those fundamentals don't work with cryptocurrency because it is outside the central banking system. It's independent on its own. It's kind of driven on sentiment more than anything else. But Cryptocurrency, I think there is a place for it if you're looking to build for the future. I think it would be foolish to ignore it. I can't sit here and say don't invest in it, because the performance speaks for itself. And if we see anything with cryptocurrencies right now, we know for a fact that it is going to continue to be around for the future. So what I would say is, if you're going to hold it within a portfolio, definitely do your research. Understand that it is very, very volatile, really, really volatile, just like stocks, right? Let's not compare the two and say that one's worse than the other. The benefit that you have with stocks and shares is that they've been around for a very long time. So you can kind of, maybe not predict it, but you can manage the risk based on past performance and technology and experience and knowledge of knowing how that market operates. Bitcoin and cryptocurrency is relatively new, so you can't make an informed guess based on past data, really, not to the same extent that you can with stocks. So is it worthwhile holding? Yeah, absolutely. I think definitely it's worthwhile holding. But what I would say is, do your research, make sure you understand the pros and the cons of each, and decide how you're going to use it. Are you going to use it solely, or are you going to use it as part of a wider portfolio? So I talk a lot about diversification. Even if you're buying stocks, right, you don't want all of your eggs in one basket. The same principle will apply here. You don't want to have all of your eggs in cryptocurrency and cryptocurrency alone. You probably want to use other asset classes. So, a cryptocurrency will be an asset class. Then you've got stocks, shares as an asset class, equities. You'll have property. You'll have bonds, and you also have cash, and you have things like commodities like gold, silver, those kind of things. So it's important to put all of your eggs across a number of baskets, not just in one. Hope that makes sense. If you have any follow-ons, Daniel, just let me know. Right, heard the market will crash soon. Yeah, I've been reading a lot about that. Who knows? There's a lot of talk about what's going to happen back end of this year, beginning of next year, and through the summer. I think, depending on what goes on with COVID, I mean, the states are still the United States are still in a state right now. So how long they can continue to pump money through the Fed, printing money essentially to prop up the economy, is anybody's guess. Plus the elections in November. So I think the global economy as a whole, once we kind of try and get back to normal, and the UK government, Boris, is pushing for that to happen right now, come November, we're going to see what happens. The risk that you have is, depending on what happens with the elections in America in November, there might be, well, they're saying there might be a second peak in the winter months of COVID. We don't know what the impact is going to be, but it is very, very probable. But it could also be, a false narrative as well. Nobody really knows. If we knew that, we'd be putting all our money on red right now, right? Other questions on here. IT videos in particular. Oh, that's great. Cheers. Thank you. I've just opened a money box ISA because of your comparison videos. Thank you very much. I'm glad that you found that useful. I've been watching a few videos and listening to you on Spotify over the last couple of weeks. You're very knowledgeable, but do an amazing job of breaking the info down to an easy to digest level. I really do appreciate that, because I'm always very, very mindful that whenever I speak, that I don't want to use too many jargon or like technical terms. It's hard to do sometimes, because like you're trying to explain something and the language automatically just pings into my head, and I'm like, okay, I need to dial that back. So the fact that it's coming over really, really simple, easy for you to digest, mate, that's music to my ears. Thank you. Which is now suitable for a day trader, fixed commission or spreads? I'm not a day trader, mate. That's not where my expertise lies, so I wouldn't be able to tell you, if I'm completely honest. I do talk about, the different kinds of investing. So oftentimes people confuse trading and investing. I believe, family, that it's a completely different skill set. I mean, you need to get the mentality right if you're a trader. Like, you really need to understand what you're doing. You do as well if you're invested in the stock market, but with a trader, you really, that discipline, that fight or flight, is really something that you definitely need to control. So it's not my area of expertise, so I couldn't really tell you from a trader's point of view, because I don't trade. I literally over the last 15 years of my career, certainly over the last 8, I've been building investment portfolios for people and managing money and advising on things like that. So I don't know too much about trading apart from the very, very high level stuff from being around some of the traders. I've never traded myself, so I wouldn't be able to tell you. Hope you're doing okay. Loving the investing and review videos. What's your opinion on the Vanguard life strategy funds? They're really, really good funds, mate. I mean, Vanguard as a provider, they've been around for years. They have such a wide selection of funds available to you, or options available to you when you're looking to invest, that they're very, very hard to ignore, particularly when you start looking at cost as well. They're very, 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 very well priced, and that's because they are so big. You're going to struggle to find, a new boy on the block. I won't mention names, but maybe even someone like a Moneybox, for example, who's relatively new, being able to offer the service that they do at the price that they do. And they can do that because they've got economies of scale now. They have billions and billions and billions under management. So when they're going out to basically build a fund or to get a fund manager to manage the money on their behalf, they have the ability and the power to basically say, look, this is what we're going to basically pay, or this is what we expect for this level of money coming over to you. So they can definitely turn the screw on that cost lever. The fund itself, let's just have a look at the fund. Let me just get another window up on here. Let's have a look at some of the performance on the funds. I know they've got different variations of it, like our strategy. One second, guys. Yeah, so they've got different variations of this, and this is down to, so I often talk about risk and understanding what level of risk you want to take as an investor. So they're really, really good because they've got different levels of risk. So on here, they've got 5 strategies. So they've got the 20% equity, 40%, 60%, 80%, all the way up to 100% equity fund. And what that basically means is that your exposure, according to your risk appetite, so if you start on the low side, you're going to have 20% in equity. The rest will be in bonds. So your bonds are kind of like your safe assets, right? Those are the ones where you're sending money out or giving money out, and you're going to get a set return over a period of time, right? So for your £5,000, you're going to get 10% every single year for as long as you hold that bond. So you know what your return is going to be from the outset, which means that your level of risk is basically reduced because it's a known outcome. With equities, obviously, you're invested in the markets. You don't know what the markets are going to do. The markets could be up, they could go down. By the time you finish investing, they could be down, but you're hoping that they're going to be up. So it's kind of, I wouldn't say it's gambling, but it's not. What you're trying to do is you're trying to make an educated guess based on past data, right? And based on your research that you do about the companies that you're going to be invested in. But your level of risk basically sits within your equity investment. So with them, they've got 5 funds across low risk all the way up to high risk. So they're 100% equity fund. I mean, that's aggressive. That's all of your money in companies, every single penny. And these guys will diversify. I've spoken about diversification on a previous video here. I cover this in my investment course as well. Diversification is really, really important. The difference between using someone like Vanguard and trying to do this stuff by yourself on Trading 212 is that Vanguard have floors and floors and floors of people that they pay handsomely to research how they're going to diversify your investments. When I say diversify, back to the analogy of baskets and eggs, what they're basically doing is they are researching, paying people to research what baskets you have to put your eggs in, and they will select the basket. So, for example, in one basket, you might have Apple, Tesla, you might have AstraZeneca in there, Coca-Cola, Walt Disney. You'll have big companies that have been around for a while. They do all of that for you. If you're investing via Trading 212, then you've got to figure that stuff out yourself, and that can be very, very hard to do if you don't know what to look for. Which is why the investment course and some of the stuff that I talk about here on the channel is really, really important, because it gives you the foundations of the stuff that you need in order to kind of research yourself. I also do a little bit of mentoring in terms of how you actually build investment plans as well. So on here, they've got quite a few. 5. Let's have a look at some performance. Actually, I'm interested in the moderate. So I'm looking at the 60% equity fund here. Just have a look at some of the performance. So if we have a look at annual performance in here. So this year, given that the markets have been pretty volatile, the moderate one, which has got 60% worth of equities in there, so 40% in bonds, it's about 3.6%, which you might think is pretty low, and it is low based on past performance. So back in 2015, 2016, that fund actually returned 10.5%. 16, 17, it returned 12.5%. So you could argue it's doing about a quarter of what it was just 3-4 years ago. But you've got to take into account everything that's happened. We've had COVID, we've had all sorts of stuff happen. Markets have been very, 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 very volatile. That's not actually too bad, 3.6%. So that's not bad at all. I'm interested to see how that compares with the aggressive, by the way. Let me just have a look at this quickly. Yeah, so the aggressive fund, which is 100% in equities, this year performance is 0.85. So let that sink in. Because you're taking a higher level of risk doesn't necessarily mean you're going to get a higher return, because you're carrying more risk. So within the equity element here, it's 100% equity. You're not using bonds, where we talked about the fact that you're getting a known amount back over a period of time. This is everything in equities, 0.85%. So a lot of people will argue in this scenario that actually you're better off being in the moderate fund and banking your 3.6% versus your 0.85% here. Again, this is all about your investment goal. What do you want to achieve? What kind of investor you are, whether you are high risk, low risk, moderate, right? This is all the stuff that you should know and understand when you're starting out your journey investing, when you're starting to decide where you're going to invest, whether you're going to use a Hargreaves Lansdown or a Vanguard, or whether you're going to use Trading 212, right? These are the things you should know, because the difference can be quite stark. In this snapshot right now, you're better off as a moderate investor. However, there's nothing to say that when the market starts to rocket, there is no doubt that this 100% equity fund is going to do better than the moderate one. So it swings and roundabouts. And that's where you need to understand how you diversify your risk. How do you get the balance between the two? How do you stack the odds in your favor? And how do you make sure that you've got the mentality in the stomach to basically take on board that investment risk? It's really, 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 really important. So I hope that answers the question on the Vanguard Lifestyle Funds. Quite a few questions, so let's see if I can get through some of these. Okay, Andy, what's your thoughts on index funds for diversification? You hold any, or you're more into individual shares, or a mixture of both? So Andy, I do both. So I hold individual shares. I've got Tesla, I've got Disney, I've got a handful of stuff. I've got Boeing, but I do believe that index funds are really, they're a good, cheap way for you to begin investing in the market, essentially. And you get the economy of scale of a big investment house like Vanguard to help you along the way to keep costs down, right? So for me, I hold both. I'm a firm believer that probably about 99% of first-time investors, so if you're completely new, right, that you've never done this before, I'm a firm believer that 99% of first-time investors would be better off investing in index funds to start off with, just to kind of get confidence, start to, build your knowledge, get a little bit of experience. I believe that you're better off doing that, in opposed to going gung-ho and trying to pick stock, because there's so much stuff that you could get wrong. There's so much stuff that you think that you might know that will add value to the portfolio that could be completely wrong. I mean, I've got this saying, you don't know what you don't know until you know you don't know it. And unfortunately, by the time you realize that you didn't know it, oftentimes it's because, oh, shit, I didn't think of that, or I just didn't know that. And it's normally a consequence. And that's what we want to try and avoid when it comes to investing. So I hold both. Sorry, mate, 1 second. I hold index funds and I hold direct stock. I do both. And I do both because there are some stock like Tesla, for example, where I've owned the car for 5 years. I know quite a lot about the business. I'm part of the Tesla's owners forum, Tesla's owners group, where I just want a little bit more exposure to Tesla. And that's why I do that specifically. I mean, my Tesla stock at the moment, Tesla's going great guns right now. And the thing that I guess frustrates me on YouTube, Instagram, Facebook, all over social media for that matter, is you have people who are investing and they only talk about what they hold when the markets are great. So like Tesla's $1,500 right now, right? So I've pretty much over doubled my money on the shares. And people always talk about that investment when it's going good. They never talk to you about when it's going bad. And the reason why that really pisses me off is because it gives you the impression that everything's going to be great. I remember times when the Tesla stock, everyone was bet against Tesla, and the Tesla stock was struggling. And for a lot of times, investors were at a loss. We're now getting to that point where now the stock seems to be coming good. Is it going to remain like this in the next 6 months? God knows. Who knows? Nobody knows. It might tank again. We might lose money. So it's really, really important to understand that, when you're looking to put money into these businesses, you need to take a long-term view. If you're taking a view for, 6 months or a year or two, it's not really long enough, mate. You need to think long-term and holding these things over a period of time. And also setting yourself up where if you needed to, you can take profits if you want to, because that is always a possibility. And that's often something that people overlook. But I do both because it allows me to get a different level of exposure to different companies. All right, let's have a look. Leona, okay, how you doing? In terms of content, look at your audience, age, demographic, and create content to suit them. I'm 23, just starting my investment journey. So I appreciate your investment and pension content. I suggest tax. Okay. Yeah, we can cover actually tax. Yeah, I'll note that down actually, because tax is very, very important. So I've got an investment course that covers the tax side, but I will definitely have a look at doing a video on the tax side of things as well. What else have we got here? Really good question here, Daniel. What's your thoughts on Vanguard pension over Pensionbee, as Vanguard are generally always best on their fees? You are right. I think, right, so I do know the guys at Pensionbee, and they've been on my podcast. I did a review on them, obviously. One thing that Pensionbee do differently, and so let me start off by just saying one thing, and this may be a little bit of a contradiction to many people who listen to content here on YouTube. Cost isn't the end all and be all of the game, okay? So ideally, what you want is a provider who can offer you something low cost, but still has the professional, technical ability to help you on your investment journey, right? That is the marriage. That is the best marriage you could come across, right? Really good, reputable company, been around for ages, lots of experience, lots of technical ability to help you on your journey, and low fees. That doesn't often happen, okay? Now, with Pensionbee, what they've done is they're pretty new. And I've been in the industry for 15 years. And if you've been in the industry, you'll know pensions are old boy, boring, so complicated, unnecessarily so, like really unnecessarily complicated. Like you try transferring a pension from an old pension provider, it's a nightmare, like a complete and utter nightmare. Paperwork going missing, requesting information. A lot of the stuff isn't really computerized properly, so they have to go digging out stuff. Just the general administration of it could crazy. I mean, I've done pension transfer requests for people, and it's taken 3 months just to get the information back before we even start the work to transfer the pension. That's just getting the primary information. Nightmare. Now, Vanguard has been around for a very, very long time, and they are a little bit slicker than the others. But what Pensionbee has done is they've completely modernized the entire thing. Like, it's on your phone. You can see it, you can touch it, you can feel it, you can contribute. They've got a lot of functionalities that some of the older firms like Vanguard and other people, Old Mutual, for example, just don't have in place. And that's what they've done that has been really, really nice in terms of just making it a little bit more accessible to people, a little bit more friendly. They freshen up the way they talk about pensions, the way they explain pensions as well. But on fees, Vanguard is always going to be best. So if I reference back to the marriage that I'm talking about, technical ability, experience, track record, with fees, Vanguard win on that one. I mean, completely. If you're looking at, okay, ease of access, ease of monitoring, just the general feel of how things come across and, access to information, then I would argue that Pensionbee would be a better option on that side. It really depends on what you're looking for, if I'm honest, Daniel. Okay, so here we got one here. How should I educate myself before I turn 18 so that I know what savings accounts I should open and what investing apps/websites I should use? Do you have any advice for starting young? Mate, listen, that is music to my ears. Right, so a couple of things for me. If you watch some of the videos, I'm going to repeat some of the stuff that I put in there, right? So first and foremost, the fact that you're even thinking about this, fucking love you, mate. Seriously. Perfect. First thing you need to do, whatever job you start, whatever you do, no matter what it is, make sure that you save a percentage of what you earn every single month without fail, right? So you need to be really, really tight with this. You need to really, really be tight, as in you're going to have money coming in. Yes, you want to go on holidays and have beers and, go out with your mates and have a great time. Absolutely. Still do that, but task yourself a percentage. It could be 10%, 20%, 5%. I don't care if it's like 10 quid, right? Every single month, put that money aside, invest it into something. Now, the best place that you can start, tax efficiency is king. So things like ISAs, very, very first port of call, ISAs, because it's your biggest tax allowance. So you've got a £20,000 tax allowance every single tax year. The tax year runs to April the 6th to April the 5th. You invest that money or save that money into an ISA, be that a cash ISA or a stocks and shares investment ISA. Do that. In terms of apps, there's a number of them, mate. There's so many of them. You've got Wealthify, you've got Moneybox, you've got Plum, you've got Wombat, the guys that I reviewed on here. There are so many of them. I think a lot of the time it is going to be about personal preference in terms of how you feel about a company, or whether you feel that they present you with information in a clear fashion that you get on with. And for that, on my reviews, the two best companies that I found who present information really, really well, really, really easy. You don't have to go digging for stuff because it's just tucked away somewhere, are Wealthify and Nutmeg. Those two, in terms of the presentation of the information, so it's easy for you to understand, easy for you to find without you having to dig through stuff and jump through hoops. They are by far the two of the best. But then again, I haven't reviewed everybody on the market. So that's just my opinion based on the guys that I have reviewed. But mate, listen, you're on the right track. Trust me, please, all right? Please just make sure that you set aside a percentage of your earnings every single month. Believe me, you will thank yourself in the future, and you have no idea how much money you can amass if you just keep it going as a regular habit. And the key word is habit. Form the habit. Yes, it will be difficult, and it's okay to build a sum of money and be like, okay, well, I might need something you dip into, as long as you're disciplined in terms of, right, you need to be tight in terms of your budgeting, your money in, your money out, allocating money. I call it bucketing. You need to know exactly how much you've got to pay for like rent, your essential stuff, how much money you're going to allocate to going out, enjoying yourself and living life, go on holidays with your mates, and the amount you're going to have for investing. You need to have a third pot. Often what people do is they have two pots, essential pot, another pot for everything else, right? They completely forget the third pot. And every single wealthy client that I've ever worked with has three pots. They have their essentials, their stuff for life, the stuff they want to enjoy, and they have a pot for money, like investing into the future. So you need to have that. Make sure you're disciplined with that. And again, it doesn't matter if it's 10 quid a month, 20 quid a month, 100 quid. Mate, if you could do 100 quid a month, trust me, by the time you get to 30 odd, 40 odd, even if you can look longer term than that and go 50, trust me, you're going to be absolutely laughing. A lot of people want to retire early. This is the way to do it. So the fact that you're thinking about it, mate, great. Evelyn, currently investing via Moneybox, but now want to move onto either Fidelity or Vanguard. Just don't know which one to choose. They're both really strong companies, mate. So it's a tough one. How do I compare the two? They're both. I've done stuff with both of them, and they've both been around for a very, very long time. In terms of that marriage of technical ability, experience, and all that kind of stuff, right? They're pretty much both on par. I think Vanguard is a little bit cheaper than Fidelity, so it will be really about what your triggers are. But in terms of names, reputation, size, technical ability, experience, they're both up there. At this stage, I'll be looking at things like cost, because on the technical ability side, it will be pretty much on par with each other. So cost will be a big option for you. So have a look at what it's going to cost, and then see. But by the way, I don't know whether you've watched the ISA video, right? But let me just give you a little tip on here. If you've invested with Moneybox in an ISA, please just don't go and close it and then open a Fidelity or Vanguard and just go pay the money in. You can't do that. So if you're going to move and it's in an ISA with Moneybox, contact Fidelity or whoever it is that you're going to use, Fidelity or Vanguard, one of the two, and ask them to do a transfer for you. You have to do a transfer. They'll be able to do it pretty easy. It's something they'll be very, very useful to, but that's just a tip, just in case you are investing into an ISA with Moneybox. You just can't close it, take your money out and go and put it in with Vanguard. You'll be breaking the contribution rules that way, all right? So how do I invest in an index fund? Can it only be done through a website like Vanguard? Vanguard can help you. Hargreaves Lansdown offer them. There's a number of them that basically offer them. I mean, to a certain extent, even people like Wealthify and stuff like that, those will be index funds, because effectively an index fund is basically a basket of shares. So it's a basket of companies that you invest in. So a lot of the providers now will be able to provide you with the ability to invest in an index fund. Thoughts on Wells Fargo stock? I haven't followed Wells Fargo, if I'm completely honest, mate. Let me just have a quick look now. Let's see what we can find on them. I know they had a little bit of a torrid time, if memory recalls correctly. Wells Fargo. But they are a big, big firm in America. Really, really big firm. $25.48. It's not, okay. See, they're a bank. So with all banks have suffered in recent years. And what the question you have to ask yourself is competition, right? So let's look at it here in the UK. You've got Monzo, Starling, and all these guys that are new kids on the block that are offering technologies that the older boys just can't compete with. Like, well, they could, but they can't, because in order for them to provide some of the stuff that Starling, like stupid things like, payment transactions straight away, it comes off your balance, right? Not all of the banks are doing that now. And like, that is so simple. And the reason why they can't do it is because their systems are so old that if they were to try and incorporate that, it's going to cost them millions and millions and millions, and they don't want to spend the money. So one thing you've got to think about when you're looking at a bank stock specifically is, who are the competition out in the States? Right? Who are the new kids on the block that might be the ones nicking, new customers, like people like yourself, off them, that would traditionally go to them, but are like, no. They're just, I don't know, incapable of moving and keeping up with the times in terms of what is needed, app access, all this kind of like easy to access information. You need to ask yourself that question. And if you're going to buy this stock, research competition like really, really well and see who their competition is. Old boys, like existing banks out there, and new entrants as well. That would be my one pointer. That's what I would do if I was looking at Wells Fargo stock. I'll be looking at their competition and who's nicking business off them. Is there any new boy on the block or new company on the block that is gaining market share, possibly stealing, taking customers away from them? Because I know for a fact, I worked for RBS for 10 years and I've had my account with them for much, much longer than that. And literally, I moved from them to Starling without even blank. I didn't even blink, and I had a black account with them. And, great account, great benefits, but NatWest is NatWest, RBS is RBS, and Starling is just a lot more modern and offers a lot more flexibility with the accounts. And it's just simple things like opening an account. Like, why should that be so hard? I wanted to open a separate account for an emergency fund last year, and it's like, well, it's going to take 7 days to open the account. I'm like, really? Like, on Starling, it's open within like 24 hours. It's absolutely crazy. So do a bit of research on that. Okay, so you've got quite a few here. So let's try and see if we can get through these. Right, so Javin also started using Trading 212. I know that they offer Vanguard ETFs. Could you briefly explain their benefits as opposed to individual company stocks? Okay, so an ETF is an exchange traded fund. So typically what happens is when you invest via, let's just say Fidelity or Vanguard or someone like that, Wealthify, Moneybox, right? What will happen is you will invest in a basket of funds. So your fund is already built, right? And it will have equities in there, so companies. You might have some exposure to like bonds, which are the stuff that I spoke about earlier, where you're basically giving away money, but you know what you're going to get back as your capital and your return. And it will have things like property funds in there, or property, commercial property typically, a little bit of cash. It might hold some commodities like gold and oil and stuff like that, right? Now, when you invest in funds like that, what tends to happen is that the portfolio will rebalance. And that might, when we say rebalance, imagine you have, let's just say, 30% of your investment in equities, right? And let's just say you have Tesla in there. Now, Tesla's gone nuts right now, right? So your asset allocation, so the amount of your investment in equity specifically should be 30% at all times. It shouldn't go over. It should be 30%. At least that's what you expect, and that's what the mandate that they invest on should be. But when you have stocks increasing in value, what can happen is Tesla goes crazy, another company goes crazy, and because you're building up money in profits, your 30% could go to 35. So what tends to happen is that these funds will rebase. So what they'll do is they will recalculate and reset themselves so that your equity goes back to 30%, right? And the fund manager will do this in different ways. They might profit take and put some money in cash, then look for opportunities to go in elsewhere. But essentially, they will rebase. So typically, it's half yearly, once a year. You might get some that will do it quarterly, right? Now, that's just a system in terms of managing your money. And that's how most of them actually work. Now, with ETFs, exchange traded funds, they can be traded on a daily basis. So they can rebase on a daily basis. So it means that if you wanted to kind of like get out at a position at any given day on any given time, it's easier to do that via an ETF than it would be in a fund. With a fund, well, you've got to send the instruction in and then they'll trade it on that particular day, but it's not really set up to do that. So an ETF will give you a bit more flexibility, a bit more transparency around the cost that you're buying these shares at, and it gives you a bit more ability to have exposure to particular companies. Typically with an ETF, you might have ETFs that will track the FTSE 100, for example. So the FTSE goes up one day, that ETF might actually track the performance of the FTSE 100 and replicate that, and then you can sell at the end of the day if you wanted to. With an index fund, you don't have that kind of fluidity or that flexibility to be able to act in that way. So that's just a simple way to explain it. Let me know if you have a follow-up question. Right, where are we? Alex M94. For medium risk long-term investor, where would you have your LISA, SIP, cash ISA, and stocks and shares ISA respectively? Where would I? That's a hard one to answer, mate, because, yeah, I mean, what do you mean, where would I? I mean, if you're talking about how the investment is actually built, then I can give you an example of what the asset allocation would be. So when I mean asset allocation, I mean, right, so when you invest, there are typically 4 asset classes, right? And I cover this in my investment course. There's equities, there's bonds, there's property, which is normally commercial property. Then you might have something like cash, or you might have commodities as a 5th, right? But typically there are 4, and those are the 4 most popular ones that investment companies will use. Now, if you're a medium risk investor, what will tend to happen is you'll have more in bonds than you will do in equities, right? So for example, with the Vanguard Life strategy, the moderate one is giving you, actually, no, let's go more low risk. Let me just close this quickly and I'll just show you. So on the moderate investment for Vanguard, they're actually having 60% worth of equities, which for middle of the road, some will deem to be quite aggressive still. So some people would argue if you're middle of the road, you should be 50% equities, 50% bonds. But it depends on who you're using, because again, you're giving them your money to invest on your behalf, and they are employing a team of people to run the investments and to do all the research. So depending on the fund manager that you have who runs the team managing your money, they will have a view of, right, okay, we think that for a moderate or medium risk investor, we should have 60% worth in equities and 40% in bonds, or 6% in equities, 20% in bonds, 10% in property, 10% in cash, right? It depends on who you're using. So when you're doing your research, it's important for you to pay particular attention to the fund fact sheets. So if you're using Moneybox, Vanguard, Fidelity, any of them, they should be able to provide you with a fund fact sheet. So your fund fact sheet will explain what your asset allocation is, how much you have in equities, how much you have in bonds, how much you have in property, how much you have in cash, how much you have in alternatives or commodities. So by understanding what that is, then you can gauge for yourself and say, okay, I'm happy with having 60% worth in equities as a medium risk investor, or actually no, I would want something with a little bit more security in bonds, for example. So it's hard to say where I would put it. I'm a medium risk investor. Well, I'm not actually a medium risk investor. I'm an adventurous investor. So I'd probably go much more high risk than what these guys have here, because that's just my nature. But it really depends on who you're going to use. So pay attention to the fund fact sheets, and then you need to judge for yourself and say, okay, are you happy with having this amount in equities or this amount in bond, this amount in property, if that makes sense. All right. Let me know if you have a follow-up question. Let's have a look. The two best ones, I would say, is Fidelity or Vanguard, but both have a good range of index funds you can invest in. Yeah, that's right. Is there a simple way to work out stocks' true intrinsic value? People can use like dividends per share and stuff like that, and that's basically taking a calculation of what dividends they pay, and I think you divide that by the amount of shares that they have. So there are simple calculations that you can do to find that number out. A lot of the time, though, what you've got to remember is that share price oftentimes isn't a true reflection of the actual business. The share price is a snapshot of the performance of a business at a given time, right? So take, for example, Tesla right now, right? People are saying that stock is way overpriced because you have a look at, $1,500 a share. I mean, the company hasn't been around that much. I mean, it's valued more than Ford, that has been around for years and years and years, and one of the biggest car manufacturers on the planet. So, share price is important, but it's a snapshot of a business at a point in time. It's no indication going forward. So again, don't just buy stock based on share price. You need to do the research, the fundamental research behind it, and that boils down to, balance sheet. Are they highly leveraged in terms of debt? What do they sell? How do they make their money? What new products or innovations are they bringing to the table? How well is that likely to do? Are they targeting new markets? Who are they? Who's their leadership board? My video where I talk about how to invest wisely, where I've got the Tesla on the cover, I explain a lot of that there, and that's the stuff that you need to look at, not looking at the intrinsic value and working out the dividends and all that kind of stuff is important, but not as important as the fundamentals. You really do want a company with a good balance sheet. I mean, that's primary. You need to have that, and to have a good balance sheet, they need to be turning over good money. They need to be making good profits, because dividends are paid out of profits. If they're not making good profits, then they're not going to be paying dividends. So the balance sheet becomes really, really important from there. All right, now where am I now? Is there some way I've got on something that? Which broker do you use to invest in someone like Tesla? So I use Hargreaves Lansdown, but I've also started to use Trading 212, just because I was just curious to see how it actually worked off the back of the review video that I did. I've also got free trade, but I've not funded it. I'm actually going to be doing a review on Wealth Simple next week on Friday, because that's the one that people have constantly requested as a review. But I use Hargreaves Lansdown. I use Trading 212. I hold my Tesla stock with Hargreaves Lansdown though. So I've only just recently bought Facebook with Trading 212. So I use both. Experiences are different. I mean, with Hargreaves Lansdown, obviously you can only buy full stock. You can't buy fractional shares with Hargreaves Lansdown. So that's one thing to bear in mind. Whereas with Trading 212, you can buy a fraction of a share with Tesla or Amazon or AstraZeneca or any of the companies that they list there, because they are set up to work like that. Whereas Hargreaves Lansdown, you can't buy half a stock in Tesla. You've got to go 1,500 quid to get one share. You can't buy half, you've got to buy full shares. So that's one downside of Hargreaves Lansdown, but that's traditionally how things have been done, which is why Trading 212 and free trade and the like are really, really popular now, because it allows people access to these stocks without having to, have a huge outlay. It lowers the barrier to entry effectively. I want to definitely put in my earnings into savings at the moment. I'll look into those apps for those, mate. Look, you make my day saying that. Trust me, Gigi, you really, really do. So, if you have any questions, do find me. Man, I just started investing, but I need a new bank account because the old one has limited debit and I can't use it till next month or get new. Which type of account do you recommend I use? Trading 212. What if it's a bank account? So what do you mean you've got limited, has limited debit? What do you mean by that, mate? Give me a little bit more info. Because regardless of who you go and bank with, they might have restrictions in terms of how much you can send. And that's really just down to anti-money laundering. So you couldn't just be able to send 10 grand without verification. You just couldn't. All of them will have limits. So yeah, just let me know a little bit more, mate, and I might be able to answer you on that. Should I stay with Trading 212 for big investments, 20K and above? I tried IBKR, but minimum amount you're buying is 100 shares on NASDAQ. Yeah, I'm not that wealthy. Yeah, look, so what you're basically asking there is, yes, some of these other investment propositions, because they might be proper stockbrokers, they will have minimums. And the reason why they do that is because they want to attract a certain kind of person. Effectively, that's the reason why they do it. And commissions and stuff. So if you are just looking to start out small, and you want to invest in small companies and you're adamant that you want to do it on your own, then Trading 212 can help you, free trade can help you. There's a few of them. Robinhood coming to the UK, or Robinhood have had issues, big issues in the past. I would just say though, guys, make sure you do your research. This is really, really important. Make sure you do your research and make sure you're comfortable with what you're doing. What companies are you buying? Why do you want to buy them? What kind of investor are you? What do you expect? When do you need the money back out? Is it long term? Is it short term? These are all the things that you really need to be clear on. Look, mate, if you're there's not a bank in the UK that I'm aware of, unless you have a black card, that is going to allow you to send 20 grand on a debit card. Not going to happen, mate. Anti-money laundering rules. They can't do that without verification. And that's not just there to protect them. It's also there to protect you. Imagine you lost your card and they allow someone to transfer 20 grand into a trading account. You'll have them over the coals for that. So there are limits in place for a reason. Anti-money laundering is a big reason, but there's also that protection of your money, just in case you were to lose your stuff, your card. So yeah, you just need to be a little bit, mindful of that, because there aren't any banks that are going to allow you to do that. Even if you were, with Coutts, for example, where you can have a black card with and you spend whatever you want, they'll still want to verify that it's actually you that's doing the trade, because that might seem to be or be deemed by them as suspicious activity, not for any fault of your own, but because that's what they're there to do. They're there to basically keep money safe and to adhere to rules. Okay, Alex, follow up to my above question. What providers do you recommend at the moment? Let me just find your previous one, Alex. Okay, so this is for LISAs, SIPs, cash ISAs. So in terms of the reviews that I've done right now, so apart from all the big boys, so the Hargreaves Lansdown, the Fidelities, the Vanguards, the new age ones, I'll be looking at Wealthify, Nutmeg. Those will be my two, because they present the information really, really easy for you to understand without you having to dig through the website. They're very, very transparent. I just like the way they lay things out. And again, when I do those review videos, I'm looking at it from the point of view of, well, if I was a first-time investor, would that information that they're giving me enable me to kind of like understand what I'm doing without having to second guess or doubt myself? And I believe that those two in particular, the ones that I've reviewed, lay out information in a way that's really, really good, very, very transparent, and they lay out the adequate enough information for you to know what you're doing without having to second guess yourself. Okay, does Trading 212 charge you for holding stocks for 1 week? No, as far as I'm aware, Trading 212, if you're purchasing stocks, then no, there is no fee or anything like that included with the service. That's completely free, which is another big selling point for Trading 212. I enjoy watching videos. You're very helpful. Do you recommend cost averaging with Trading 212 or buying a stock and holding it? Okay, well, pound cost averaging is basically the idea that if you invest on a monthly basis, that effectively what you're doing is you're buying shares at different prices every single month. So markets are volatile, right? So shares will go up and down every single month. So it means that if you're buying, say, Apple stock, for example, at $100 this month, next month it might be 120, which means you're getting less for your money. But the month after that, it might be at $80, which means you're getting more for your money. Pound cost averaging is the effect that has long term, right? So pound cost averaging means that you're picking up these share prices at different prices over a period of time. And what that basically means is that when the markets go up, you should see an increase in your values over time. Now, that in comparison to buying stock and holding it, I assume you're just meaning a lump sum investment. There are studies that have shown that lump sum investments do outperform pound cost averaging. But the problem with that is you have to have a lump sum to invest in the first place. So for first-time investors who don't have a lump sum, that just simply want to start investing, pound cost averaging is absolutely fantastic because it allows you to get started in the game and it allows you to reap the benefits of being invested in the market to start off with. So it really depends on what your circumstances are. I would say if you're a first-time investor, you just want to get started, just get started, start sending money in. You'll get the benefit of pound cost averaging automatically. And, you know, as you gain confidence and your portfolio starts to grow and you earn more money as you go through life, then you can start throwing, you know, lump sums in with bonuses and stuff like that. So don't let it be a deterrent. This notion that you need to have a lump sum or, you know, pound cost averaging, pound cost averaging is great. It's great for beginners. It's great for anybody investing in the stock market. It's there to basically do a job for two different sets of people. Okay, so Daniel, do you transfer your workplace pension into someone like Vanguard or Pensionbee, English Scottish widows currently? Mate, yes and no. I'm saying yes and no because it completely depends on what kind of workplace pension you have. There are some workplace pensions that you should definitely not transfer. So if you haven't got me on IG, message me on IG. There's stuff that you need to know, and there's stuff that you really need to be careful with it, mate. You definitely do. I'm guessing you're going to be in your 20s and 30s, so you shouldn't have any issues with final salaries or defined benefits. But if I'm wrong, message me because you just need to be careful. Yes, you can transfer them, but you need to make sure it's the right thing to do for you. Ideally, you should be taking professional advice just to make sure that it is the right thing and you're not giving up something, a guarantee of some kind that you're not going to have by transferring to Pensionbee or Vanguard. So find me on IG and we can talk about that a little bit further. Okay, Alex, could you do a review on some of the peer-to-peer lending platforms as a way of making money like Zopa, Reddit, but I can do, I mean, peer-to-peer, it's very, very popular right now. And I get the appeal of peer-to-peer, higher returns, obviously, but higher risk. And there was a directive by the Financial Conduct Authority last year that basically said, put a little bit of a stipulation around the kind of people that should be using peer-to-peer. So I'll put it on my list to do, basically. But with peer-to-peer, you need to understand that you are taking a higher level of risk, which is why they are effectively offering better returns. And oftentimes these companies do fail. There aren't really any guarantees that you have around them. So you need to make sure that you're doing your due diligence, but I'll put it on the list. Right, okay, so this is a follow-up question. Bank account restricted to 6K and I have money in the account, but I can't pay anywhere. I need to open a new bank account only for investing. How many money should I put into trading 212 max? That's a tough one, mate. Is whatever you feel comfortable with. Again, you need to do your research on. So one of the things that I always say, right, and again, this is in my investment course, I've mentioned a couple of times on the videos. You need to make sure that if you are using a provider, that they are covered under the Financial Services Compensation Scheme. Now, Trading 212 is, and basically what that means is that if you were to invest money with Trading 212, the Financial Services Compensation Scheme will cover you up to £85,000 if they were to go bust. So you actually have a means of getting your money back. There are hoops to jump. It's a long process, but at least you have something giving you some kind of protection, right? Now, for when I was advising, many clients would use that as their kind of like their ceiling. So I'm not going to have more than £85,000 with this provider. I'm going to put another £85,000 with this provider. I'm going to put another £85,000 with this provider, right? So that gives you a level of protection. Some providers have this phrase, and Pensionbee has this and a few others, where they offer you protection under the Financial Services Compensation Scheme to no upper limit, which means that if you have £1 million, you'll be protected for £1 million, which is always a nice bit of comfort. But you need to do your own research, and how much you're going to put with their max is really down to how much you feel comfortable with. That's a very, very personal thing. But I would definitely say, make sure that, they are covered by the Financial Services Compensation Scheme, Trading 212, that is what you're going to be, what you will feel comfortable with. That basically matters the most. Which broker Warren Buffett or Pro at trading users? They claim big awards. I don't understand the question, mate. Rephrase that again for me, please, bud. Yeah, okay, Daniel. So you're 28, so you won't have any issues with any defined benefits or final salary pensions or anything like that. But again, depending on how much you have in there and how Scottish Widows has performed, again, ideally you really want to be having taking advice, really, to be honest. And if you were to transfer to someone like Pensionbee or Vanguard, they'll probably get you to sign like a disclaimer to say that you have taken advice. So you should speak to someone just to make sure that it is the right thing for you. But I get the logic behind transferring into a Pensionbee or into one place, because like I said before at the top of this, with pensions, there used to be this thing that you never saw. And people like Pensionbee have changed that massively. They have revolutionized the fact that you can have it on your phone and you can see it. You can see how it performs, easy access. It's right there at the forefront of your mind because you can pick up your phone and you can actually see it. So there is a huge appeal to it. Absolutely. And I completely get it, but just make sure it's the right thing for you to do. All right. Okay. I think we've got through all of the questions. That was quite a few questions. Thank you, guys. I will try to do these on a regular basis. I would love to be able to do these every week on a Sunday at 9 p.m. But I think we'll just work up to that as we go along. There's been quite a few of you who have actually watched this right now and quite a few questions. I would love to have more and more of you on here. But I really do appreciate your time this evening, guys. I really, really do. Again, if you haven't found me on IG, please do feel free to find me, Conversation of Money, on IG. The podcast I know many of you have listened to, do go and check that out as well. We're always producing content. I do have a couple of things out at the moment. I'm working on an event, a financial literacy event, where I'm actually teaming up with a load of finance professionals across all kind of different fields. So you talk about, buy to lets, buying your first home, investing in crypto. That was a question on here. I've got Tyrone coming on to give a guide on how to begin investing in crypto. That event is going to be August the 15th to 16th. It's going to be a digital event, so it'll be hosted via Zoom. I will post further details about that a bit later on. So if you find me on IG, it will be on there. I might post something in the community on here, but I'm really active on IG more than anything else. So if you want information on that event, it's going to be a 2-day event. You can buy tickets to either 1 day or 2 days, depending on what your preference in content is. But we're covering 10 topics effectively, 10 topics by 10 different speakers, all of which are professionals, just like myself in financial services. And the idea is that we basically want to provide you the information and that education that we just didn't really get at school, stuff that will empower you to achieve your dreams and your goals in life, knowing that money is a tool to help you get there. I do have my investment course as well. If anybody's interested in that, there's a link to that in most of the videos in the descriptions. But guys, I do appreciate it. My next live will probably be my next live will be, where are we right now? We are the 12th. Probably be in 2 weeks' time too. Probably looking at the 26th, around about the same time. 26, 9 p.m. that Sunday evening. Yeah, just bring your questions along, and then we can go from there. I think there's a few more questions that have just dropped in here. Let's get through these before we call it a day. Which bit of okay, James, another super informative video. It's so refreshing to hear someone talk so openly about money from a UK perspective. Mate, I really do appreciate that, because that's the reason why I do this. And it took me a while to get to YouTube, but I just couldn't kind of just sit back and see some of the stuff that's being put out on YouTube. One thing that I find, and this is one thing that I say all the time on IG, and I'm going to say it here, so it's here and people can always come back and watch this. If you wanted a root canal done, you wouldn't go to a gynecologist, right? You'll go to a dentist. If you wanted eye work done, you definitely wouldn't go to a neurosurgeon, right? You will go to the appropriate professional. And what I find here on YouTube is there are accountants talking about investing when they have no business talking about investing. Yes, it's easy to Google stuff and be able to repeat stuff that you find on Google, but the nuance matters. The nuance matters. When should something be used? When should something not be used? You can't get that from reading something off Google or watching a video off YouTube. And that's a lot of the time on YouTube. There's just like, it's just like a wheel that's just churning out the same stuff. I see the same stuff and it really winds me up. It's all these same topics with a different take, but they're all fundamentally saying the same thing. Like, there are nuances to these things and you need to understand them. And you're not going to understand them if you've never been in the industry or worked with this topic, this subject matter. I'm not an accountant. I would never produce content about bookkeeping, right? Or filing your taxes. That's an accountant's job. If you're talking about investing in the markets, you need to speak to someone who actually has worked in an industry in wealth management, has advised clients, someone like myself. Unfortunately, there aren't that many people like me on YouTube providing this content. And it frustrates me, and it's something that needs to change. And, it took me a while to get here, but this is the reason why I'm here. So, there's lots of misinformation out there. Just whenever you're watching videos, ask yourself the question, what do you want done? What procedure do you want done? And is that person adequately qualified to perform that? Because if they're not, then you shouldn't really be listening. It's easy to read stuff on Google and regurgitate. It's the nuance that matters. So I really do appreciate you guys. And thank you so much for dialing in. Just keep an eye on the channel. But I'll speak to you guys on the 26th on Sunday. If you have any questions in the meantime, find me on IG and leave me some comments on the videos. I always make sure that I respond to every single one of them. Have a good evening, guys. Thank you.